Hello everyone. Welcome to this detailed tutorial on the mutual fund separation theorem. By the end of this video, you'll have a comprehensive understanding of what the theorem is, how it works, and why it's influential in the world of finance. Let's get started. The mutual fund separation theorem is a pivotal concept in modern portfolio theory. Essentially, posits that all investors, regardless of their risk preferences, can achieve an optimal portfolio by combining just two mutual funds, a risk-free asset and a market portfolio of risky assets. Let's break this down with an example. Imagine you have two investors, Investor A, who is risk-averse, and Investor B, who is a risk seeker. According to the theorem, both could potentially achieve their desired outcomes by investing in different proportions of the same two mutual funds. If Investor A wants a safer portfolio, they might allocate 70% of their assets to the risk-free fund and 30% to the market portfolio. Conversely, Investor B might allocate 30% to the risk-free fund and 70% to the market portfolio to target higher returns. Similarly, by altering the proportion, Investor B aims for higher returns with higher risk exposure. Here's the graphical representation for Investor B. The rationale behind the theorem lies in the efficiency of capital markets. Let's discuss why this simplification to two funds is theoretically sufficient. In an efficient market, all relevant information is already priced into the assets. Therefore, the market portfolio is considered diversified enough to achieve optimal risk-return trade-off. By adding a risk-free asset, investors can adjust the level of risk according to their preference. Let's visualize this with a graph showing different allocations between the risk-free asset and the market portfolio, and their impact on return and risk. As you can see, with increasing risk exposure, i.e., moving from 0% to 100% in the market portfolio, the expected return also increases. This leads us to an interesting question. What if the market is not efficient? The accuracy of the mutual fund separation theorem relies heavily on market efficiency. In markets that are less efficient or when certain assets are mispriced, the simple two-fund separation may not hold true. Here are some questions to consider. How does the introduction of taxes, transaction costs, or inflation impact the applicability of the theorem? Let's dive deeper by considering real-world challenges. Taxes can reduce the expected returns, particularly on the market portfolio where capital gains are more likely to incur. Similarly, transaction costs can eat into the returns if frequent rebalancing is required to maintain the desired risk levels. Here's a quick example. Assume a 15% tax on capital gains and a 0.5% transaction cost for each trade. If Investor B needs to rebalance their portfolio every quarter, the transaction cost could significantly impact net returns. Given these real-world considerations, it's important to understand that while the mutual fund separation theorem provides a foundational understanding, practicality might require adjustments. To wrap up, the mutual fund separation theorem offers a simplified and elegant approach to achieving optimal portfolios. However, one must account for real-world factors like taxes, transaction costs, and potential market inefficiencies. Thank you for joining this deep dive into the mutual fund separation theorem. Don't forget to like, share, and subscribe for more finance tutorials. See you in the next video.